Hello and welcome to Stockwatch Live. Online electronics retailer AO World, which posts full year results on Tuesday, has already warned that adjusted earnings before tax will be at the lower end of market expectations. Revenue will be around £900 million, and while AO trades in the UK, Germany and the Netherlands, 83% of that £900 million revenue is expected to come from its UK business. If that's accurate as well, it would also represent a rise of around 9% on the previous year, excluding sales from Mobile Phones Direct, which AO acquired for £32.5 million in December. Shareholders will probably want an update on its stockpiling situation. Last time around, the retailer said it had stockpiled around £15 million worth of its most popular products in case of a chaotic Brexit. Now, AO is only one of many manufacturers who are stockpiling goods at the fastest rate since records began in the 1980s because of the prospect of a no-deal exit. AO's share price has taken a battering over the past 6 months, sliding from 131 pence in January to as low as 91 pence in April. They're now around the 108 pence mark. Broker Jefferies International maintains its hold rating on AO and thinks there's upside to the shares, setting its price target at 130 pence. Peel Hunt also says it rates the shares a hold, but clearly thinks they have further to fall, having cut its price target to 102 pence. I suppose it will all depend on how Tuesday's results play out, and if it's more negative news, its advertising slogan, AO Let's Go, may take on new negative meaning for shareholders. Now, staying with retail and the trading update from Joules, the casual clothing chain that has so far defied the downward trend on the high street will be closely watched on Thursday. A favourite of suburban middle-class shoppers, its womenswear has proved notably resilient and is one of the few retailers to have continued to post analyst forecast beating profits and rising turnover. For the 26 weeks to the 25th of November 2018, underlying pre-tax profits increased by almost 15% to £10.7 million on the back of a near 18% rise in revenue to just over £113 million. Active customers increased by 20%, while international revenue rose by 64.2% to represent 15.8% of group revenue. So it's not just the UK's middle-class women who like its style. And you've got to hand it to Joules as well, at a time when so many other women's retailers are falling by the wayside. The retailer reiterated its confidence in achieving full-year 2019 underlying pre-tax figures in line with its expectations, but it's certainly keen to not let the grass grow under its feet. Nick Jones, a veteran of the UK retail industry, has been appointed its new chief executive. The 46-year-old, who will step in when Colin Porter leaves the role within the next year, has worked in the UK retail sector since joining the M&S graduate programme in 1995. Jones then spent 15 years at the company, including as Director of Home, Beauty and Gifts, before joining Asda in 2011, where he ran its highly successful George clothing brand. Mr Jones said he was joining Joules, itself a 30-year company, at an exciting time in the company's development, and says he sees tremendous growth opportunities for the group, driven by further international expansion and boosting its online presence. He'll start in his position before the end of the year. Now, onto something far less glamorous at first glance, but recycling is probably as dear to Joules' woman's heart as her oh-so-stylish raincoat. Cue Biffa, the waste management group. With the company having recently been given the go-ahead for a PET plastic bottle recycling site in Seaham, County Durham, expected to be fully commissioned and operational by April 2020, and with the group on track to meet its full-year forecasts, all the signs are that Wednesday's full-year results will be positive. Brokers certainly like the stock. HSBC rates the shares a buy and has set its price target at 285 pence. JP Morgan says they could go to 300 pence, while Peel Hunt and JP Morgan Cazenove, also both buyers of the stock, have penciled in price targets of 252 pence and 290 pence respectively. Having listed in October 2016 at 180 pence, they're currently around 232.5p, and it's safe to say they haven't had a steady rise. But recycling is a surprisingly volatile sector, with those new Chinese rules on importing recycled commodities, which were brought in a year ago, causing short-term weakness, and of course not to mention Extinction Rebellion. Following a protest staged by those activists, the recommended approval granted by planning officers for a waste incinerator plant near Swansea was revoked. More than 2,500 objection letters were sent in during a public consultation on the incinerator, intended to replace an unused warehouse on Swansea Enterprise Park, prompting city councillors to reject the plans. Biffa had said the new plant would process 21,000 tonnes of non-hazardous waste that would otherwise go to landfill in Merthyr Tydfil. And proving to be equally as challenging is the outsourcing sector, which has already seen the likes of sector giants Interserve and Carillion hit the buffers. Now, Mighty employs 49,000 people across Britain, providing security, catering and cleaning at banks, retailers, hospitals, schools and government offices, and is also one of the largest managers of prison escorting and immigration detention centres in the UK government. However, its shares have been up and down since the start of this year, and the warning that it expected a decline of about 10% in its order book for the year to 31st of March certainly didn't help. Citing a challenging backdrop in the industry and political uncertainty, it clearly spooked investors, already wary of an outsourced services market in which Carillion has gone bust, Interserve has been taken into the hands of its creditors, and Serco and Capita are both recovering following multiple profit warnings. Mighty, which posts its full-year results on Thursday, has already talked of narrowing the company's focus, with the acquisition of security services provider Vision Security Group from Compass last year, and the sale of its social housing division. It has insisted that even despite the fall in orders, full-year revenue is still expected to be up by 7 to 8% on the £2 billion it made in the previous financial year. Stripping out acquisitions, it said organic revenue growth is likely to be about 4%, while operating profits are expected to come in around £84 to £87 million, so just ahead of the £83.2 million it managed last year. Broker Peel Hunt rates the shares a hold and has raised its price target to 125 pence. The shares are currently trading at about 146 pence. And that's it for this week. For more on the companies reporting in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.